Welcome back to Silicon Wafers, and this is a theme we return to again and again because it has absolute pivotal importance for Putin's war machine, and that is the falling price of Russian crude oil. Putin's ship has been taking on water for some time, but has now hit an iceberg. It's called $36 a barrel of Urals crude oil. Russia's flagship Urals crude has collapsed to its lowest price since early 2023, just as US sanctions on Rosneft and Lukoil, the two giants of Putin's oil empire, are about to fully bite. India and China are backing away. Tankers full of Russian crude are circling with nowhere to go, and suddenly sanctions don't work. Sounds a lot less clever on social media than it did 6 months ago. Well, some of these details were taken from United 24 Media. Let's unpack how we got to $36 per barrel of Urals crude, what it means for Russia's war machine, and why this looks less like a market blip and more like the first real oil squeeze, not only of the war, but of Putin's time in power. Before we do, thank you to everyone who supports the channel through Patreon and Buy Me a Coffee. Your support and assistance helps to keep the show on the road, helps us to keep making this content in support of Ukraine. Let's look at the crash from benchmark price to bargain bin. The numbers are brutal. According to data from Argus Media, cited by Bloomberg and picked up by Ukrainian and Russian independent outlets, Urals crude loaded at Novorossiysk on the Black Sea dropped to about 36.6 to 36.61 per barrel on November 13th, the weakest level since March 2023. The Kyiv Independent spells it out. Urals at Novorossiysk fell to $36.6 per barrel last week, its lowest level since 2023, with the discount versus the benchmark crude ballooning to around 23.5 per barrel. This is the widest gap between Brent crude and Urals crude since mid-2023. Normally, before the full-scale invasion, Urals traded just a couple of dollars below Brent. Even earlier in 2025, the discount had narrowed back into single digits as Russia's shadow fleet got good at dodging G7 price caps. Now, as IntelliNews put it this week, the spread has blown out again, and that spread has become a barometer of the sanctions' effectiveness. IntelliNews, the United 24 Media piece on the price crash, ties it all together. Russia's flagship Urals crude has fallen to more than a 2.5-year low just days before sweeping US sanctions on Rosneft and Lukoil came into force. Urals from Novorossiysk dropped to 36.61 on November 13th, and even after a small rebound, it's still trading at an average of 23.5 to 23.52 discount to Brent, a gap not seen since the dark days of early 2023. The implications go beyond just the price drop. The Moscow Times reports that Russia's weekly oil export revenues had slid to around $1.22 billion per week in the 4 weeks to November 16th, the weakest level since March 2023 and roughly a 20% drop since late October. That's Moscow Times. Bloomberg figures quoted by the Moscow Times suggest roughly a third of Russia's seaborne crude, about 1.4 million barrels per day, is now sitting idle in tankers without a destination, parked as floating storage, while Moscow oil traders pray that someone somewhere will take the risk. This is a slow financial bleed for Putin's war-obsessed petro-state. So what changed? We've had a price cap, we've had sanctions packages, we've had officials promising severe consequences since 2022, and little seemed to make any dent on Russian energy revenues, except, of course, for Ukrainian long-range drone strikes. The difference this time is simple. Washington went after the producers, not just the tankers and traders. On the 27th of October 2025, the US Treasury's Office of Foreign Assets Control announced now is the time to stop the killing for an immediate ceasefire, said Treasury Secretary Scott Bessent, explaining that, given Putin's refusal to end this senseless war, the Treasury was sanctioning Russia's two largest oil companies, that fund the Kremlin's war machine. That's from a US Treasury press release, 22nd of October 2025. Those two companies are, of course, Rosneft, Lukoil. They're now fully blocked entities, along with a long list of subsidiaries. And crucially, the US has threatened secondary sanctions against foreign banks and companies that keep dealing with them. The Moscow Times reminded us what that means in the real world. Rosneft pumps about 5.2 million barrels per day, about 40% of Russia's total output. Lukoil produces another 1.6 million barrels per day. Together, they're behind roughly half of Russia's production and exports, according to the Moscow Times. The US gave markets a wind-down period until November 21st. Of course, today is November 22nd, so that's already kicked in, after which dealings with Rosneft and Lukoil, including many overseas subsidiaries, come with severe penalties. Legal memos from major law firms like Denton's have been blunt. US entities must cease dealings, and non-US companies face the risk of being cut off from the US financial system for helping Russia sell oil. That's quoted from Denton's. Yes, Putin senses weakness in Ukraine due to the corruption scandal and is playing off a perceived determination to get the peace deal done at any price and with unrealistic haste in Washington. But it may be the oil sanctions that are a more compelling factor in convincing Putin that this war is unsustainable for his regime. According to coverage collated by the Moscow Times, the International Energy Agency warned that the sanctions on Rosneft and Lukoil may have the most far-reaching impact yet on global oil markets and add considerable downside risk to Russia's production outlook. Energy analyst Vandar Nahari told Bloomberg these sanctions could be a little bit of a game changer, not because they magically erase Russian oil from the market, but because they inject real fear into banks, insurers, and refiners that had been quite happy to dance along the edge of the rules and handle Russia's blood oil for outsized profit. Well, India and China have also hit the brakes. For nearly 3 years, the Kremlin's message to Europe was, fine, we'll sell to Asia instead. India and China obligingly stepped in, hoovering up cheap Urals, crude and diesel, and Moscow bragged that sanctions had failed. Well, those days are potentially over. Data tracked by the Kyiv Independent, citing Bloomberg and Argus, show that the current discount on Urals reflects a widening loss of buyers in India and China. India's 5 largest refineries, together buying about 1 million barrels per day of Russian crude, have refused shipments scheduled to arrive after the November 21st sanctions deadline. That's according to the Kyiv Independent. In China, state-owned giants Sinopec and PetroChina, plus a clutch of independent refiners, have halted direct purchases from Rosneft and Lukoil, some cancelling December cargoes altogether. A Reuters piece quoted in regional media reports US officials saying that Chinese and Indian banks and refiners are moving quite swiftly to comply, not out of love for Ukraine or any kind of morality or values, but out of hard-nosed risk calculation. Nobody wants dollar transactions frozen or correspondent banking ties nuked because they chased a few extra dollars of discount on Urals crude. That's from Reuters. And the numbers back this up. According to the Moscow Times and Bloomberg data, Chinese refiners have cut December purchases of Russian oil by about 2/3 ahead of full enforcement. Indian demand has similarly fallen after the big 5 refiners stopped buying Russian origin barrels. Meanwhile, Lukoil itself has announced plans to sell its international assets. Refineries in Bulgaria and Romania, stakes in Iraq's West Kurna 2 field under a limited US wind-down license. The Associated Press notes the company explicitly linked this move to the Trump administration's new sanctions and the need to complete divestments before the November 21st deadline. That's from Reuters. India's imports of Russian crude exploded from around 50,000 barrels per day in 2020 to about 1.8 million barrels per day in the first half of 2025. China's are even higher, around 2 million barrels per day. That pivot is what kept Putin's war budget afloat after Europe turned away. Now that financial lifeline is starting to fray. The question is not whether India and China walk away completely. They probably won't. As analysts in Carnegie and other think tanks have argued, Delhi will try to keep some discounted Russian barrels flowing while loudly insisting it's just their national interest. That's from the Moscow Times, but the short-term shock is obvious. Refiners are stepping back, banks are spooked, and Russian crude is piling up in old rust bucket tankers on the water. So what does this mean for Putin's war budget? Oil and gas revenues make up roughly a quarter of Russia's federal budget, according to official draft figures cited by the Moscow Times. For 2025, energy revenues are projected around 8.7 trillion rubles. That's roughly $90 billion, with only a modest recovery penciled in for 2026. When Urals trades closer to Brent at $70 to $80 a barrel, that is manageable. When it falls into the mid $30 per barrel with massive discounts, the Kremlin is suddenly trying to run a war economy on a supermarket sale pricing discount level. In fact, although the costs of production are not revealed in Russian figures, this price in the 30s is likely to be below the end-to-end cost of extracting, shipping, and refining Russian crude. The Moscow Times quotes JP Morgan estimates that about 1.4 million barrels per day of Russian exports are now floating with no buyer. That is oil that used to be instant war revenue, now just dead weight on the balance sheet. That's in the Moscow Times. And this isn't happening in a vacuum. Ukrainian and international reporting has shown how Ukraine's drone campaign against Russian oil infrastructure has been systematically grinding down export capability. United 24 points to satellite imagery from Novorossiysk's Shakhsaris oil terminal showing critical loading and pumping systems disabled after Ukrainian strikes, a facility that handles millions of tons of crude every month. That's from United 24. The social impact is already visible. A recent report highlighted by United 24 carries a brutal headline: Russia can't pay its soldiers. Yakutia freezes military bonuses over budget crisis. Regional authorities in this resource-rich republic are reportedly suspending promised payments to troops due to budget shortfalls, precisely the kind of fissure you'd expect when oil revenues drop and Moscow squeezes the regions to keep the war funded. Again, United 24 reporting. Combine that with survey data also reported by the Moscow Times showing the share of Russian households with any savings has fallen to an 8-year low, and you begin to see a domestic picture, a poorer, more brittle society being asked to tolerate endless mobilization while the budget is eaten by war and debt servicing. Next, we look at the shadow fleet finally dragged into the light. Sanctions skeptics will say, well, haven't we been here before? Russia uses a shadow fleet, flags for convenience, dodgy insurers in Dubai, and just shrugs this all off. After the past 2 years, Russia did in fact assemble a shadow fleet, or grey fleet as it's called, of between 400 to 600, maybe some higher estimates suggest even 1,400 aging tankers using flags of convenience, ship-to-ship transfers, AIS blackouts and faked paperwork to dodge the G7 price cap. The European Parliament's research service describes how these ships regularly conceal origins, spoof their positions, and play games with insurance to sneak crude to India, China, and beyond. Well, these details are taken from the European Parliament statement. For a while, it worked. The discount on Urals narrowed back into single digits in 2024 as Russia and its buyers got better at exploiting this grey ecosystem. That's according to Intelli News. But 2025 is the year in which the West finally started hitting the machinery itself. The EU's 18th and 19th sanctions packages have now listed more than 550 vessels linked to Russia's shadow fleet, with bans on port access, services, and critically, reinsurance for these ships. AP And Reuters reporting notes additional EU and UK sanctions targeting shadow fleet tankers moving Russian oil and even stolen Ukrainian grain, plus suspected involvement in undersea infrastructure damage, raising the political cost of looking the other way. That's from AP News. A US Treasury action in January 2025 sanctioned more than 180 tankers and related companies connected to Russian exports, tightening the price cap enforcement net. That's from the US Department of the Treasury. Chatham House points to actual seizures. Finnish and German authorities impounding Russian-linked tankers in late 2024 and early 2025 as proof that the shadow fleet no longer has impunity on the high seas, but is an operational target. Those seizures, the think tank notes, offer a precedent for more aggressive interdiction. Again, that's all from Chatham House. What we're seeing now, $36 Urals per barrel, huge discounts, cargoes stuck at sea, is the result of two pressure systems colliding. One, structural pressure on the shadow fleet and services surrounding it. Two, direct sanctions on Rosneft and Lukoil, backed by real secondary sanctions threats. Well, next, let's look at the narrative war and the politics of sanctions actually work. Ukrainian economist Roman Sheremyata has been sharing the same numbers on LinkedIn, Facebook, and X. Lowest level in 2.5 years, he says, 36.61 per barrel, accompanied by the blunt message that sanctions do work. They work when they're enforced and when loopholes are closed, and that every dollar lost of Kremlin revenue is one less dollar for missiles, drones, and to pay for the occupation army. In the Russian information sphere, by contrast, the tone is anxious denial. State media leans hard into the temporary volatility excuse. It blames speculators and the politicization of markets by Washington. But business-facing outlets quietly echo the numbers. Revenue down, discounts up, Asian buyers hesitating. Analysts warn of a budget squeeze, a weaker ruble, and the need for higher domestic taxes or spending cuts if prices don't recover. Well, all of this is reported in the Moscow Times. This has crash landed right in the middle of another big argument, the blowout this week, the Trump peace plan, the so-called peace plan, the pressure on Ukraine to accept a bad deal, and the question of whether the sanctions card should be used as a bargaining chip or leverage to change Putin's calculus to force him to the talks. Well, what does all this mean and what comes next? Where does all this leave us? Well, first, the myth that Russia has easily adapted to energy sanctions is starting to crack. Urals at roughly $36 a barrel, a $23-24 discount vis-a-vis Brent, is not adaptation. It's a fire sale. The current set of US sanctions backed by the EU and UK action on the shadow fleet is finally doing what the price cap was meant to do in 2022. That is, force Russia to either offer ruinous discounts or cut its production. That's in the Kyiv Independent. Second, this directly undermines Putin's ability to wage a long war of attrition. Less revenue means less room to buy drones from Iran and North Korea, less money to plug budget holes in regions like Yakutia, less cash to throw at elites and security services when things go wrong. Well, these three are from United 24 Media. Third, this is a test for the West. Think tank analysts at places like Chatham House and the European Council on Foreign Relations are already arguing that the EU must align with US sanctions on Rosneft and Lukoil, force divestments from European assets and close the remaining gaps in shipping and insurance. If Brussels and London drag their feet, if European banks quietly keep handling Russian-linked payments, if we let the shadow fleet reroute through new flags and shell companies, the discount will narrow again, cash will start to flow, and the Kremlin will learn the same lesson it did after 2014. Wait out the outrage from the West, and Western resolve will fade, once again placing profits ahead of their own security. Fourth, there's the India and China question. Both will try to play their favourite game, performative non-alignment, while squeezing Russia for better terms and avoiding US penalties. But this episode shows that when the secondary sanctions threat is real and targeted, even these major powers start to blink. The low oil price doesn't liberate a single Ukrainian city by itself, but every extra dollar that Russia loses on every barrel of oil limits how many caliber missiles can be built, how many contract soldiers can be bribed into renewing their contracts and furnishing their families with a new fridge or sack of carrots after they die, or keep propaganda channels pumped full of cash. It makes Putin's regime more brittle and his war machine less viable. For 3 years now, we've heard that sanctions are symbolic, that the Kremlin can always find a workaround, that energy is untouchable. Well, this week, sanctions sent a different message.